So to gain an understanding of break-even analysis, let's have a look at this figure. On our y-axis, we've got dollars, and on our x-axis, we've got the volume up here. That's our revenue, and it's sloping up because as you sell more products, the amount of money you generate is increasing. So it's a positively sloping line here. We then look at the orange line, which is our total cost, and it's a mixed cost behavior. The orange line has an intercept point here. Where volume is equal to 0, we still have some sort of cost. That would be our fixed cost. Even if we're not producing any products, we still have to pay our fixed cost, which is equal to here, the intercept point. As we produce more, the volume increases, our costs go up. So that would be the variable cost component, is the slope of the line there. Where the green line and the orange line intercept, that would be our break-even point. And as we look, break-even point can be expressed in volume, or the number of units you have to sell. As we go across here, the break-even point could be the dollar amount of sales we have to generate to break even as well. If we produce less volume than the break-even point, we're going to be in this loss-making area here. Whereas if we produce more volume than the break-even point, we're going to be making a profit. So this is where we want to be. When you're planning your business, you need to know what your so you know what your targets are for how many products you need to sell to even just reach 0 and not make a loss. So to calculate the break-even point, we're going to use the contribution margin, and the break-even point is where the total contribution margin is equal to your total fixed cost for the business. So that can give us this formula. Our break-even point in units is equal to our contribution margin ratio is our break-even point in revenue or sales dollars. So let's just get right into it and calculate a break-even point. Happy Days sells its products for $12.50 each, and they have fixed costs of $35,000. Their contribution margin, their sales price minus their variable cost per unit, is $3.50. So what is their break-even point? The formula was the fixed cost, which is $35,000, divided by the contribution margin of $3.50. So our answer, $35,000 in fixed costs, divided before Happy Days even break even. We can also ask, how many dollars in total sales does Happy Days need to generate to break even? And this time we can do it two ways. The first way, we can use the break even point in units. We know that we had to sell 10,000 units and our products are priced at $12.50 each. So that would give us $125,000 in revenue that is needed to be generated before we actually break even. Or we could use the contribution margin ratio. $35,000 in fixed costs divided by our 28% contribution margin ratio gives us $125,000 break-even point. So now we've calculated our break-even point. We know fixed costs divided by the contribution margin will give you your break-even point in units. It also allows us to the ability levels. And we've got our formula from before. The profit of a business is equal to the price per unit times quantity minus the variable cost per unit times quantity minus fixed costs. And as our price or quantities increase, that will be positive on our profit. And as our variable cost per unit or fixed costs go up, that would be negative on our profitability. So with this kind of formula, so let's do a target profit question with a new business decision and some forecasting all rolled into one to see how it works. Our business Happy Days, same information, $12.50 is what they sell their products for. They have fixed costs of $35,000 and a contribution margin of $3.50. Now they're planning for the future, and they're thinking that if they go on an advertising campaign and spend $15,000 on advertising, it'll generate 20,000 units worth of sales. So now we're able to evaluate this decision and how it will impact on our overall profitability. So we can work through $12.50 and the variable cost is $9. So that would give us a contribution margin of $3.50. And we're going to sell 20,000 unit margin of $3.50 times the 20,000 units tells us our total contribution. And then we minus off the 50,000 in fixed cost. By increasing our advertising expense by 15,000, our fixed costs increase from 35,000 to 50,000. If we were able to sell 20,000 units, we'd make a profit of 20,000. If we had additional forecasts, such as if we spent a little bit more on our advertising and we could estimate how that will link through to our sales, we can evaluate at what point it's going to be paying off, when there's a cost, or when it's beneficial, or when it's too costly to. So far we've been doing our break even or targets on businesses that just sell one product. But we know most businesses sell more than one product or provide more than one service. But we can use this same framework to apply to businesses that have multiple products or services. And what we're going to do is we're going to calculate a weighted average contribution margin. So to do that, we need to estimate our sales mix between our different products. So for example, here we've got product A and product B. We think that 64% of our sales will be product A and 36% of our sales will be product B. We can calculate the contribution margin for both of the products, our sales mix percentage, to get a weighted contribution margin. So for this business that has one product with a $3.50 contribution and one product with a $4 contribution margin, when we multiply by the sales mix, we get a weighted contribution margin for each of the products. We add them together, can then use this contribution margin number in the same way for our break-even point and our target profit analysis, which is multiply through by the sales mix at the end once we know our break-even point in units or dollars. So a quick revision, break-even analysis is a really important planning tool for managers. To do a break-even analysis margin, which is the sales price per unit minus the variable cost per unit. You can then calculate the break-even point as the fixed costs of the business divided by the contribution margin per unit. If you want to do a target profit calculation, fixed costs plus your target profit divided by the contribution margin per unit will help out there. And if you've got multiple products or services in your business, you should calculate a weighted average contribution margin across all your products using your estimated sales mix. This is just the start of the